I'm Edja, your host today, and I'm excited to dive into Qtrade's new options trading future and strategies with you. Brought to you by Trading Central, please take a moment to see the disclaimer on your screen. This material is for informational and educational purposes and is not intended to provide specific advice about, without limitation, investment, financial, tax, or similar matters. Let's welcome Gary Christie, Head of North American Research at Trading Central. With over 15 years in financial markets, Gary's worked with TD Bank and Bank of America, is quoted in Bloomberg, and speaks globally, including at the New York Traders Expo. He's here to guide us through the new options trading future. Quick note, with webinar format, all mics are automatically muted and cameras are turned off. Submit questions through Q&A function. We'll have 15 minutes for Q&A at the end, and we'll also pass on any extras to Gary for answers. A video recording will be provided post-webinar. Please give a warm virtual welcome to Gary Christie.
Hello, everyone. Thank you, Edja. Thank you for the Qtrade team for having me today. It's an absolute pleasure. I'm going to share my screen right now, so bear with me for a quick second, and we're going to get into some fun today of options and a brand new product that I had the pleasure of building with our team here at Trading Central. So you should be able to see my screen today. Of course, we're here to look at the Qtrade Options Lab, and as a co-creator, it's a good time for you to ask questions. Follow along if you're logged in, by the way, and play around. You'll see some real-life examples today, and we're going to have some fun using the tool. So again, I know Edja gave me a nice warm welcome. My job, I am now director here of North American Research at Trading Central. I'm based in Ottawa, where our main office is. I'm also the general manager here in the Ottawa office for Trading Central Canada. And part of my job is giving directional views on equities, Forex, futures contracts, you name it. So we advise hedge funds and institutions all around the world on market direction, as well as build the products. And we really want to empower retail traders to really have the necessary tools to be successful in the markets, whether it's technical analysis, fundamental, right? And options today, you're going to see one of our newest flagship tool to help us really navigate complex options strategies. So I call myself a trader. I mean, that's my passion. I've been trading for many years now, specifically in options. I was an options specialist for a prior bank, did a lot of years at as an investment representative. So I've gathered a lot of questions coming in from traders around the world and the challenges faced with options. And today we're going to help simplify that process. So there's a lot to talk about today. I'll get through some slides so you have a basic context. Again, just for compliance reasons, let's keep our lawyers happy, right? You're going to see some real life trades today and actual strategies. Again, I'm not here to give advice, although that is my day job. That's not the point of today. Today is more to empower you to make tools, to use the tools effectively and make your own decisions, right? So it's all self-directed. Okay. So, I see questions coming in. I'm going to do my best to answer them as I go through the presentation. And if I don't get to it, we'll leave some time at the end. I'll do my best to make sure we have at least 10 minutes at the end, and the Qtrade team will yell at me if I'm going too long. So this will be fun today. And let's just see a little bit about me now. Let's talk about Trading Central in general. So if you haven't heard of us, we've been around since 1999. We're known for technical analysis as our backbone of how we grew up in the industry, giving directional views, bullish or bearish. And now we've branched out to multiple different avenues. Now we have fundamental insights. We have a quant-driven approach to fundamentals. We have news and sentiment and options, so on and so on. So we cover around the clock 24/7 the markets. So I have a team here in Ottawa of analysts that will cover all tradable instruments until I finish my day around 6 p.m. I'll hand it over to our Hong Kong desk. Our Hong Kong analyst team will continue the analysis, and then they hand it to our head office, which is in Paris, France, where our larger team of analysts will do majority of the prep work for the U.S. market open for us. So I don't have to get up at 5 a.m. and monitor the markets. I trust my team to give us the relevant information, and it's a 24-hour clock. That's how we work, just to understand the context of what we do at Trading Central, product development, to really give insights, and of course, market analysis. And you can find a lot more about us on tradingcentral.com. I won't waste too much time today on that. We want to get right into the fun, why we're all here today. And it's important to understand some key principles of options trading and really what this tool is about. It's about probability and volatility and understanding how that affects your strategies and your outcomes. And we've developed a simple way to do that to point everyone in the right direction. Again, it's not going to be a perfect strategy every time. That's not the point of this tool. It's not trade ideas. It's making sure that you can cover all bases with multiple different strategies, maybe you're never even aware of the risks involved, right? So we want to be pretty clear on the max risk, max profit, probability of profit. We'll get into that today. And if you have questions, fire them away. But really, what is options trading, right? So, I mean, we're not going to go into a deep dive as to what an option contract is. There's lots of education. Qtrade has some available as well. I'll have further webinars on products. It's more about how to use this tool and what should you be aware of the most. And we're talking about probabilities. This tool has been built around probabilities. And how we do that is something called delta. Delta gives us a probability. Will the option expire in or out of the money at what percentage? And we built all our strategies around that, right? So every option trade has a probability of profit, a POP. You'll see that on the screen, right? Higher the better, but it may forego some profit potential. Okay, so keep that in mind, and we'll show you some real life examples. So higher probability trades usually come with lower max profit, but possibly more win consistency. And the whole point of this product is to help you trading options, everybody out there, to be more consistent and profitable when they're trading. You're not going to be right every time. You don't have to be. That's the beauty of trading. You could be right 40% of the time and still make pretty good money, all right, with a disciplined approach. And this tool is really a disciplined approach to options, which we'll show you in a quick second. Okay, so again, I'll share these slides. I won't go through every one today because it'll be part of the presentation at the end, but I want to give you some basic concepts of what we're trying to achieve here. The key principles, right? Options can be used for more than just speculating, right? We know a lot of people like to go long calls and puts, but you have to get a lot of things right to be right in the options game. You have to get time right, right? You have to get your direction right, right? And the volatility. So these are all very challenging, and this tool is designed to help you decipher that to make a better decision on your direction or on your strategies you choose. So of course, a lot of people are very familiar with covered calls for income generation, right? But there are risks involved to that compared to some spreads or credit spreads you're going to see today. And we know a lot of option traders, especially in this day, this volatile times we're in the marketplace, like to hedge their positions. If you're long 100 shares, how do you protect yourself on the downside when, say, earnings are coming up, right? And how can you do that effectively using the least amount of capital? And yes, I'm seeing questions coming in, and yeah, we will send the slides out to the audience. Yes, so I won't spend too much time here. You'll get a chance to have a copy of these. These are basic knowledge principles I'm sharing here, okay? And we want to make sure we're understanding what we're trying to achieve. So we have of course probability is a big factor component of this, and options decay. This is one of the factors that really new option traders struggle with, right? You can be right on the direction of a stock, but still lose on the option, right? And there's a reason for that, and this is the time decay component, which we've thought of in this product. So, right, unlike stocks, options lose value over time due to time decay. We call this theta. Buyers of options are always fighting against time. You have to be right pretty quickly to make money on options, where option sellers benefit from the time decay. They forego a lot of profit, but may have a better chance of success, right? Because they take advantage of that time decay component, right? This is why credit spreads are often more successful for probability-based traders, but there is no right or wrong strategy, okay? So we have to decide that on our own, okay, of what kind of trader we want to be. So I know this is a lot of concepts here on theta, probability, time decay that could seem quite advanced. And yes, I understand that. We'll show you in the tool how to benefit from this. I'm not here today to teach all these concepts. That's a whole other webinar, which we look forward to doing in the near future. It's more of how do you drive a strategy as quick as possible, okay? So, all right, so we have theta decay, then we also have liquidity as a concern in option trading. And what I'm sharing here is the major aspects of why people fail trading options. And we know that most traders do fail trading options because they don't understand the key concepts to protect themselves when you're looking for a strategy, right? So this product here today you're going to look at with the Options Lab already filters for options liquidity. Now, what is that? We have to make sure we can get in and out of a trade efficiently with not a big spread on the bid and ask if you're doing spread trades. The bid and ask pricing structure must be liquid and tight, right? We must have a lot of daily volume in the instrument. Otherwise, you can get some very big mispricing, and there's a risk involved to that. Okay, so we're looking for stocks with a lot of open interest, a lot of trading volume. You can get in and out efficiently, and they're priced efficiently. We'll show you what that looks like in a quick second here. Okay, so we have a built-in liquidity filter out of 3 stars, 3 being the best liquidity, meaning it's pretty safe to consider that instrument or that stock based on the options liquidity. This is important, and we'll get to that as well in a quick minute. So the most important part of the tool that we're quite proud of is that the Options Lab really will not suggest strategies unless there's adequate liquidity. Okay, because you can have a lot of stocks, and if you're doing a search and you're putting in a stock, and you're looking for options, and it doesn't come up, it's most likely for a significant reason, right? It's usually we can't price it accurately enough to create a spread or to protect you on the risk side. Okay, so here's an example, right? Apple and Tesla, very popular names, Nvidia, so on and so on, have highly liquid options, while some small cap stocks, some junior companies that don't trade very actively in the day may not have any options, may have some that have pretty obscure expiries, wider spreads, and it's going to be a bigger risk. And we want to make sure when you're trading options, you have a chance to be successful. And yes, we'll get to what the products include. I see a question coming in. We're going to add ETFs in the very near future. We're doing testing right now. We just don't want to suggest strategies just because. That's not what we do at Trading Central, right? We want to make sure when you suggest a strategy, it makes absolute sense based on your opinion if you're bullish or bearish. And we'll get to that in a quick second. So these are the key principles that we're going to show, and this is how we design the product to help you. So we have a lot of data in here, and I encourage you to log in and play around with it. And if you have questions, now is the best time to do that, right? So because we have some new indicators never really seen before in the marketplace in a new, fun, and engaging way. Okay, so we have we have volatility data points now that are quite visually appealing, right? To give you a quick idea of what the volatility looks like for that instrument to help you be successful in selecting certain strategies. So key things to remember: high volatility, like we're experiencing now, right? Usually drives option prices higher, right? They become more expensive. Low volatility, cheaper in options, right? Understanding implied volatility, you will see IV for implied volatility is really the key to picking the right option strategy. Now, it's also, there's no guaranteed win here. What we want to show, and you can see in this graph on the chart, the history is volatility expanding or contracting, right? This is what we want to try to gauge. And we have to make an opinion on that. If you think volatility is going to expand and you're bullish, this could be good for option buyers. It'll make their options more expensive to help you out, right? If it's the opposite effect and volatility is contracting and you're long options, this, even though the stock is moving in the right direction, your options could become cheaper and you can lose money doing that. So it is a challenging game. Make no mistake, options, they're not for everyone, but you can do them in a responsible way. And what we want to try to achieve here is, can you replicate being long shares, but use options instead with lower volatility, or lower buying power, right? And you can have more assets. You could be long more stocks with less buying power, which ultimately leads to a more diversified portfolio potentially. There's a lot of ideas around this we'll share today, but this is some of my favorite features here. And I'll go into each one once we're in the platform, of course. But it's important to understand the concepts. There's a lot of information out there in the web. You can learn about volatility and IV. It's not complicated. It uses some complex jargon that we're trying to change with this product. We've changed some of that, and I'll explain to that as well in a quick second. But you must understand IV to really be successful in options. You just don't want to buy calls because you think the stock's bullish or buy a put because it's bearish. There's a lot more to that, and we're here to guide you. And this tool does that, I think, in one of the best ways out there. So the next and final phase of this really is the volatility cone. You're going to see this in the product. This is something we're pretty proud of, to give you a realistic expectation of where you think the stock's going to go by a certain period of time. Now, make no mistake here, this cone really is useful for even just stock traders, right? This is the first thing I check before I consider a position. And it's a second check for me to understand, do I have a realistic expectation of where do I think the stock's going to go in my time frame? Maybe it's in the next 30 days or 10 days or 6 months. This volatility cone expresses, based on options premium volatility, the possible range, the likely range within one standard deviation, or roughly 68% of the chance it will be in this area, inside the cone. And we like strategies that are inside this cone. And I'll show you what that looks like in reality. But again, a very useful tool, even for just stock traders. If you have an idea about where you think, in this case, Amazon's going to go, right? And this is looking at May 16th monthly expiration on this option. If you think it's going to go to $500, maybe double check, because the probability is not likely, although not impossible. Keep that in mind, right? Anything can happen in the markets. No one knows what's going to happen tomorrow or even the next 5 minutes in the marketplace. We want to make sure you're set for risk, right? Understand the risk involved. How can you protect yourself, and how can you be successful with realistic target prices? And we'll get into that in a quick second. But this is one of the most popular features of the platform, understanding volatility. And now we can do it in a visual way, which is much more easier to understand, in my opinion. So again, the last component here, we've added a feature which is more to do with our analyst side, which is pretty unique. So we have a technical opinion to help you figure out a direction of the stock. Again, very useful for just stock traders alone, but we want to make sure we have target prices and support and resistances to help us generate our ideas using strike prices. So if you're trying to decide what strike price should I use, a lot of technical traders will look at current support, the red lines here on the chart, and resistance, the green lines. And we have an opinion on over 9,000 stocks at Trading Central, and we're sharing that opinion inside the Options Lab, which is pretty unique. So we have a preference, and it's based on a trend following model. We use a top-down approach to Trading Central, where we analyze the longer-term, say, weekly chart over 5 years, and we break it down to daily, over daily bars, and then intraday, and then we can have an overall opinion of what direction do we think the stock may go based on probability. And that's just there as a guidance. I use it mostly to help us with strike prices, to understand, where should I look for a target? And does it fall within this volatility cone, which is extremely important? And I'll show you some real life examples. So again, pretty important here. If you want some guidance on stocks, activate the technical view feature. You can deactivate it. It's not there by default, but it is a super powerful tool. And that came from our institutional business at Trading Central that we provide to hedge funds all around the world, right? They lean on us for their timing and their trade entry and exits, and really to help identify interesting support and resistance levels. So moving on, I'm checking some questions as we go through here. And I see, do we have paper trade at Trading Central? Not on our site at all. So we don't do paper trading, but we're going to use this tool kind of like a paper trade. And I'll show you how I do that, because I test this product on a daily basis, and I take screenshots. I look at positions that I might want to follow, and then I copy actually the strategy card, and then I'll go ahead and at expiry and evaluate how would this have done, right? So paper trading, does help you understand how a tool works. I'm not a fan of it in terms of, can it help you make money in the markets? Should you paper trade and be profitable before you trade real money? That's an open debate, right? Because we're losing the aspect of psychology when you start paper trading. Once you have real money on the line, it's a different game completely. And definitely with options, it's going to enhance that, because there's a leverage component to options contracts. So again, demo accounts are fantastic for learning how to use a tool. Absolutely be a professional at the tool, know it like the back of your hand. But once you get into trading, the only real way to learn from our experience is by doing it and putting real money on the line and trying it out, and having the courage to step in to do a spread or do an options contract. And this tool is designed to help you bump that gap from stock trading into options trading in the most efficient way and fun way. And I have a question right here on Fibonacci support resistance. So Fibonacci is a way to gauge swing highs and lows using mathematical numbers and a series of patterns to help us decide, is there support or resistance levels available? I will tell you, we do use it, right? When there's a new high happen. Because the challenge is in technical analysis, when stocks are making new highs like they have been over the last 2 years, how do you have a target price? We can use Fibonacci extensions to help us have a target price. Again, it doesn't mean as much because price levels have never been there before. But yes, we do use them as part of our training plan, right? So again, the final slide I have here today before I jump in, because I want to give it at least 20 minutes on the tool and have it open for questions. Key points about specifically Options Lab, right? Our option strategies use proper mechanics, right? So it's a disciplined approach we're using, taking into account volatility data already and time value, right? Probability and volatility drive the strategies. And we're trying to replicate being long stock or short stock with similar probabilities of profit using options. That's what we're aiming for here. It's not going to be a lab that has complex strategies like iron condors and certain butterflies. We're not into that. We're keeping it very, very basic and simple because we're focused on someone who's never traded options. How would you do it, and what's the best way to do it successfully? From our experience using math and probabilities and proper structure. Okay. So, and again, the last, point, understanding volatility is really the key to success, right? This is where what causes most people to lose money in options. They don't understand volatility. And now we have a simple tool to give you an edge on that. Okay. I see some questions coming in again. So, is there a back test function? Like a time machine, not in this tool. We're not here to do back testing. Again, these are not trade ideas specifically. They're designed to point you in the right direction. You may fine tune the trade once you're at the order ticket. Okay. So that's not the point of this product to back test. It's not made to give positive alpha or try to outperform the market. It's more of an educational tool to get you in the right area to be successful and to consider what professionals look at when they're trading options. It's really what our team uses every day. We only suggest strategies that we would actually take in reality. We're not just here to give you some random strategies. This is very important to know this. Okay. All right. And yeah, I know from experience, because I was a registered rep. I know specifically for option spreads, there's different rules that will follow in terms of tax-free accounts and RSPs. Spreads not always are allowed. Covered calls are. Talk to your broker. The team will answer those questions for you. But yes, this is for more complex options spreads. Normally, you need a margin account, right, to do that. But you can hedge with inside RSPs and TFSAs, and we'll show you some examples. That's quite fun. So let's do that right now. I'll do a live demo. I'm going to jump right into the Qtrade platform, and let's follow along together. And as I'm doing that, loading in, I see a great question. Someone asking, should this strategies based on existing portfolio positions? That is the next iteration of the product, right? In the future, what we can do is, and we're testing that right now, is we can tap into your holdings and then suggest strategies to either hedge, create income, or lower your average cost base. That's the future of the industry, right? Obviously, there's some compliance issues with that right now, so we're doing what we can with the regulators. But to be really effective, I do believe we should be able to tap into holdings and suggest covered calls on that. But for now, you'll just have to do it on your own, be aware of the stocks that you own, and plug them into this tool and play around with that. So let's just jump right in. So I'm just going to exit this page and jump right into Qtrade. I'm going to refresh the browser to make sure I'm still logged in. Now, where do you find this tool, right? So go into, and I'll just hover over investment tools. And then there is the new flag of Options Lab. And encourage, again, you all to follow along. Please log in. All right. And once you're here, there's going to be some basic information to be aware of. Of course, this is only for U.S. stocks right now. Okay, so keep that in mind. The U.S. market has a little bit more liquidity, right? So and we want to suggest strategies that make sense from a liquidity standpoint that are realistic. And our best testing is done the first iteration on U.S. markets. And then we're going to introduce Canadian options in the future. But we know Canadian options have a small volume pool, and majority of people mostly do one type of strategy, right? Covered calls, a little bit harder to do spreads because of liquidity. But that's going to be coming down the line. So we have that indicated here only for NYSE and NASDAQ, okay? And only stocks that have adequate liquidity. So not all stocks will be available in here, despite the fact that they may have options listed. That's by design. It's kind of a protection, as one of our clients would say. So making sure I'm not trading something it probably shouldn't be, and causing me to have less of an edge to lose money. So we do care about liquidity, and we'll get into that in a second. Okay. So there's an FAQ that's great here that the Qtrade team provides on options too. I encourage you to play around with that. Again, I'm not here to do education specifically on strategies. Although, I know that's probably something coming down the line that we can do and we can talk about with your team, talk about with the Qtrade team and what you're looking for. We want your feedback today on what what are the challenges you're having with options specifically, and we can enhance the education to tailor to that need. But we built education built into this tool, so it should be pretty self-explanatory. And let's just get into that right now and see. Okay, so the first thing you want to do is put in any symbol, and it's a smart search again of U.S. stocks. ETFs are coming soon. Keep that in mind. And we don't have index options yet. That's up for debate, right? There are some risk associated with index options and buying power requirements. So although we can do it, that's more of a discussion later on to see, can we do it in an effective way? Is there a demand for it? So on and so on. We want your feedback on that. But keep in mind, Canadian options are coming. For now, it's U.S. based equities. Okay. So if I put any symbol here, again, this is not here to give me advice. I'm putting a pretty popular symbol, Apple. You could do a quick search by name or by symbol, and you're going to get a nice icon here and the company name. Okay. So if I click on that, all right, I'm going to restart. It remembers what I did last, but here's a landing page of Strategy Lab, right? So we have Apple, we have a context of the market, and what we're trying to achieve here with options, with the Options Lab, is to really give you context of the market before you decide on your strategies. And this is important. We have a chart in front of us. It's interactive. You can zoom in with the scroll wheel, take a look at the chart. This is Apple daily. You can change the time frame, right? And we're going to provide you a volatility cone if there's one available. We have to have sufficient amount of options for this to happen. But this is one of my favorite things inside this tool, right? Understanding volatility and having realistic expectations. Okay. And we can see from this cone now that we have April 16th is the expiry that we're looking at right now. These are monthly standard option contracts. We're not dealing with weekly options right now or end of day options. This is, again, to replicate being long or short stock. We need time on our side. So these are always going to have at least 30 days to expiry to help out with those directional trades. And yes, if you can't see it, I see someone asking for zoom. Let me try to zoom in here. And I'll appreciate the feedback. You guys are very engaging. So if I'm missing something, let me know if I can zoom in. This should help. It's an iframe, so it will adjust to your mobile. So it's going to look a little bit, a little squish and adapt. Okay. But thank you for that. So we have Apple here in the chart. We have 4 monthly expiries available. We know what to expect here in terms of the range. Now, if you don't know what to do with Apple, and maybe you want a second opinion, and technical views is that second opinion, and I'll answer a question I see in the chat from Chris about accuracy of technical views. But if you want an opinion on this stock, what should you do in terms of a trading plan? As soon as I activate technical views, you're going to get a commentary. You're going to get a preference, right, from our analyst team. This is from me specifically because I cover Apple as an analyst at Trading Central. But we have, what's our preference? We have a stop loss or thick blue line at 218-ish area, right? 219 to be specific. And that is our support level. You can see why it's called support. We bounced here twice, right? And you haven't broken below that right now, despite the market having a wild ride to the downside last few days. So we have a support level. We have a bullish scenario, right? Because the overall trend has been bullish. Right? This is a trend following methodology. It's been trending higher. We consolidated. We posted some record highs, and then we've been chopping around since this trade war started. Okay. Now, someone says if you're not getting the cone, I would make sure you're on the right time frame. Defaults to 6 months, and make sure it's a stock that has listed options as well. If you don't get the cones because we can't find adequate monthly expiries, we need usually at least 3 of them. Right? We don't want to give any kind of data that could be skewed because of inadequate liquidity. But that's a quick trick to get it. So leave it in 6 months, making sure it's a stock, or just change the stock. Right? Not everything's going to have a volatility cone. For those that are experienced options traders that understand the math behind it, we use what's called the at the money straddle to decipher these quotes. So we're taking the at the money call and put from April 17th, and we're projecting it out in terms of a price. So if it's, in this case, if it's a $15 at the money call, right, we can see why it's from 235, last close is 250 on the upside. We're projecting it based on option premium. Okay, that's how we develop this volatility cone. We have all those in the FAQ as well, right? You can hit the question mark and you can learn how we calculate this. but I'm here to empower you quickly because I only have maybe about 10 minutes to show you all the features. Again, this is to set you up. If you like our analysis, we have some resistance ahead of us at 244 and 250. Now we can go ahead and say, hey, Gary, I like your opinion on Apple. I want to try for a bullish strategy. Then they can start answering the questions. And it's a simple 3-question system here to get you into the right area in terms of options. And yeah, for timeline, I think you can go out a year on this and zoom way out. I think it's a maximum of a year of data for now. Because we're dealing with between 30 and 60 days of option strategies, we don't want to go out too far. But you can do that inside actual chart, inside the charting at Qtrade and pull up a longer term chart. But for now, we want to focus on expiries and the cone. So now I can select one of 2 options here. Do you think the stock's going to go up or go down? Right? We're keeping it very simple here. We want to replicate being long or short stock, right, for now. And they're all defined risk, right? Meaning you're not going to get into a situation where you have unlimited, a margin situation where you can lose more than you put in. We're keeping it very simple, right, and define risk for safety. So in this case, if I like to go up, I can answer the next question. How bullish are you, right? So we have 2 questions here. Is it slightly upward is your preference or significantly upward? We have to ask this question because it helps us drive the aggressiveness of the strategies in terms of spreads. And we'll show you what that looks like in a quick second. But here, I'm just going to pick anything here because we have overhead resistance above us from the technical opinion. I'm going to say slightly upward, right? If I was maybe at a record high, I would say, significantly upward because it could be a whole new trend. But again, this is subjective. Pick your own preference. The final question here is, what are you focused on? A lot of people trade options for many different reasons, okay? There's no right or wrong reason. Keep that in mind. Majority of the time, and how we built this tool, I like to trade options to limit my risk, okay? So we have a definition of what that means. If you're interested in managing risk more effectively by utilizing strategies that have clearly defined risk characteristics and you want to limit potential losses, you'll stick here. Maybe if you want to create income or cash flow, right, and you want to sell options to sell some premium, maybe covered calls, that's where this area sits in, okay? So look at focusing more on credit spreads and selling calls. Then we have some strategies, as we know, some people just like to make as much money as possible, right? You want to focus on what's the maximum amount I can make on this strategy, and you may forego some of that, probability, right? But you're accepting more risk for maybe possibly a higher return. There is a way to do that properly, right? Using proper mechanics, right? So we get that, okay? And we also have a high probability of profit. If you care about the math, that POP will show you in a second. You can focus on strategies that only focus on that, okay? And generally those are more credit spreads, right? Or at the money strategies that are in them, or in the money strategies that have a better chance of success. But you might be paying a little bit more for that. Okay. And then the final one here to cover all our bases is maybe you're long 100 shares of Apple right now, right? And you're long above, say, 219, our current daily chart stop loss. Well, what happens if you get below that, but you don't want to sell your stock, right? Maybe you want to hold on to a stock because a dividend's coming up, okay? But you want to sell, but you want to protect yourself from downside, either because earnings are coming up maybe, or we have this choppy bearish market. Maybe we're entering a bear market or tech stocks are getting slammed. Whatever reason it is, there is a way to hedge that or like buy insurance, which is really what options were designed for originally, right? Not so much speculation. It was as a hedging tool. You can do that as well. So let's just see what these look like. If I select limiting my risk, okay, and I select, as soon as I click on show results, I'm going to get 3 strategies. I'm zoomed quite in here. I'm going to zoom out a bit, so I apologize, just so you can see the context of the chart, okay? So what do we see here? The most preferred strategy is a bull call spread. If we don't know what a bull call spread is, just hover your mouse over the I. We'll give you the definition. It involves buying a call option and at the same time selling another call option with the same expiry at a higher strike, right? This is used to lower your cost than outright buying a simple call, right? And we want to compare strategies, and this is really important, okay? So we see a bull call spread. This is quite a nice $10 wide bull call spread. You're risking $445 a contract to make possibly $555. We generally want to be in that 40 to 45% probability of profit in these trades. It's the best way to replicate being long stock, okay? But you can see the benefit of doing this. Right? You're foregoing some profit potential than owning 100 shares, but you don't have to put up the capital it requires to own 100 shares. You're only putting up $442. Okay. You have 44 days to expiry. We're looking at April. And the real beauty here is that it falls within the volatility cone, which is very important, right? We don't want strategies with strike prices way above it on a long debit spread. We want to make sure that the stock has a chance to hit that 245 area, right? And in this case, we have a pretty interesting setup because we have two major target levels, right? These are all our target prices based on resistance that fall within that April 17th volatility cone. Okay. This is one of the best features, and I can't stress this enough. This is extremely important because you want to have the best chance of success when you're doing debit spreads. Okay. And you want to make sure that you have a realistic chance using probability. This falls in and meets multiple criteria. You have a bullish scenario. Okay. You have a debit spread that's $10 wide, paying almost half the width of the strike, right? Okay. And it falls within the expected move up to 249 and within a target price based on the technical picture. So this is what we call like a higher probability setup. Okay. If you choose to be bullish, right? Currently, where Apple's sitting, it could be bullish or bearish, right? So it's pretty neutral and choppy. But it's up to you to decide what direction and opinion you have, and we're going to support you along the way, making sure your strategy makes sense. And the whole point of this is to make sure if you're going to do a debit spread, right, with at least 44 days out, you should be near this ballpark, right, to have the best chance of success based on probability of profit. If you're not there, then maybe there's something wrong, or maybe you want to retweak it. Maybe you can also tweak it and maybe make it tighter, $5 wide. There's no right or wrong answer here, okay? But in this case, we're just trying to make sure you're in the right ballpark to be successful. If you want to go just long call, maybe you don't have the ability yet to do spreads. If you're going to do a long call, it's the best way to do that is near the money or at the money. We have a 235 long call here, paying 865. It's going to cost you a little bit more. So notice the difference. The whole point of a bull call spread is to make it cheaper to be directional, right? And you're paying almost half the cost as a simple long call, right? So that sold call, you're selling at 245, is really helping you lower the cost of the whole trade, and it's bumping up your probability of profit, right? This is what most people do when they're doing spreads, right? They're looking for that near 50% probability of profit, lowering their cost. And you can have a lot more positions open with the same directional bias using less buying power. That's the beauty of options. Okay, so you can have the same exact exposure as you would being long shares, but at least your max risk is 447 or even 865. That's the most you can lose. What if Apple keeps tanking lower and lower if you're long 100 shares? You can lose a lot more money on a single leg stock than the options. Something to think about, right? So this is all about risk management. Okay, we see your break even here as well. We update this every 2 minutes behind the scenes. If I keep this on the page, you'll see it refresh quite often. Okay. The long call, if I click on that, you'll see the payoff and the risk. Okay. Obviously, unlimited upside potential. That's the trade-off here, right? Right. On the long call, you lose some probability of profit down to 36%. It costs a little bit more, right? But you have a potential to make a lot more money. Okay. And then you always want to offer at least one credit spread, right? And this is quite interesting. We have a nice $5 wide credit spread. And this is because volatility has increased in the marketplace. We'll show you what that looks like in a quick second. But you can see here, when I click on this, it all falls within the probability of the cone, which is the quick check, okay? And this is the least dollar risk of all the strategies, a credit spread, right? So who would have thought, right? Sometimes certain strategies aren't so risky if you know that the max risk and you keep it to simple basics. $5 wide, we're making $160 a contract and we're risking $340. Okay, we have a higher probability of profit because of the time value component. Time decays. So I know a lot of traders will only focus on this type of strategy, right? Again, there's no right or wrong strategy here. I'm not saying this is the best way to do options, right? But if you're going to sell options, consider this format. Right? It will help guide you into the right area. If it's way off from here, maybe there's something you got to double check. Okay. But the main point I wanted to stress here is that 340 risk versus a bull call spread 453, less risk, higher probability of profit. And I want to encourage you all to try different names out, different strategies, different stocks, because it'll be different based on volatility. Okay. So I'll just quickly change a different type of scenario to show how quick this is. So maybe I don't want to limit my risk. And most of the time, I sit here. I leave it to default. If I close out of the browser and go back into Qtrade, it's going to remember my preferences because most of the time, this is my main strategy, okay? Limiting my risk. That's me personally. That's not for everyone. That's what I like to do, okay? Maybe you want to hedge. If I protect my long position, quickly show results. Right away, it looks like 3 long put strategies if you want to buy insurance with different levels of risk or cost involved. And you can see that on the chart. You want to protect yourself on the downside. We got 230 put costing 660, right? If you want to have a higher probability of profit of this working out, 34% on the downside, a little bit tighter, 235, and there's a 245 as well, right? In the money to really protect yourself if you're worried about an instant decline. But it's going to cost you a lot more, right? And that's okay. Keep this in mind. It's going to cost more. It may work out, and it's for a reason, okay? But we're giving you options here on options, right? To suit your buying power, right? And your risk level if you want to protect yourself. Maybe you want to just write premium or lower your average cost of the shares. If I quickly click on creating income, cash flow, I have some covered calls now, okay? So this is assuming you already own 100 shares, and it's assuming it's at the last current price. So if I'm worried about Apple going down, I want to sell some premium, I can create $4 and lower my average share cost by $4.33 by selling the 245 call at 433, right? We can make potentially $1,600 on my 100 shares by selling this call. You have a pretty high probability of profit, but you're going to cap your upside potential as well. And there is downside risk, right? So I know, covered calls have been the most popular strategy or the safest strategy to start, but you still have to be right on the stock, right? The stock could theoretically go to zero, right? And you can lose more. So a credit spread helps us mitigate that, okay? Instead of buying the shares. So this is all to help you explore different options, right? I won't go through every scenario today, but you can quickly go up or change it to bearish if you want in 2 seconds. I'll just select go down, and I'll go ahead and say limiting my risk, and right away you have a bear put spread now, right? Again, you will always see it fall within the probability of the cone, right, to have the best chance of success, right? And this is pretty fat premiums now. I think it looks like puts are more expensive than calls maybe, which is interesting. So on that note, how could you decipher the volatility situation of Apple? This is where the dashboard comes in. Once I click on the dashboard, I'm going to be in a whole new world of interesting data points for volatility. So right at the front, you're going to have implied volatility rank, right? We have it at 67, and 7 days ago, it was 47. So volatility rank has increased higher. This is pretty attractive for premium sellers or credit sellers and traders that do credit spreads. We have a definition of what this means, right? To assess, this is designed to assess the current 1 month implied volatility of a stock relative to its historical levels over, this is 12 months, okay? So it's to gauge, is it relatively high or low based on history? Higher, the better for premium sellers. Lower, the better for debit traders, but not always. So we're giving a bigger picture here, not just about IVR. IVR by itself may not be as useful. You have to look at other things in terms of volatility. What do we have here, right? So we have volatility levels in terms of the spread. And this is based on the chart, okay? So we have an implied volatility, right? Expected volatility right now in blue, and it's historical volatility over the same period. What I like to see here and how I use this is looking for trends and inversions, okay? So what we're looking here is that we can see the implied volatility has suddenly increased above its historical norms. This may be an advantage to option buyers if the trend keeps going up and the stock is bullish, right? Or even option sellers, maybe it's telling us we have a little bit extra premium, right? There's no right or wrong answer here. We just want to show you the history of volatility in a nice graphic to know where's the trend going to help you with that time component, right? That time decay. This is where you can be wrong on a stock direction and still make money in your options because volatility is increasing if you're long a long call, for example. Now, what else do we have here, right? We have an upside downside volatility bias. This is a different way to really describe the skew, right? For those that have heard skew before, it's telling us based on the current option chain, what's more expensive, puts or calls right now. We can see right now on the downside, we see puts are more expensive than calls, right? And it's no surprise based on how the market's been reacting. People are pricing in premium to the downside. Maybe they're looking for protection on their shares. So all that to say is a quick glance, downside has more risk. There's a preference to downside, right, in terms of the option chain. Then we have the timeline volatility bias. This is telling us skew, right? But in a new, easier to understand format of language. Timeline volatility bias, all it's saying is what's more expensive, short-term dated options or longer-term ones based on volatility. Right now, we're slightly skewed to the short term because the markets have been quite volatile. So if you're the shorter term you go, you're going to have to pay a little bit more of a premium on those options. So we're trying to give you a whole quick picture as fast as possible on the picture of Apple. Okay. Now, the couple of things at the bottom, we have key data. The next earnings report is important to understand. Okay. So that will affect your volatility. This is May 1st for Apple. If there's a dividend that could affect you if you're selling calls, right? Be aware of the ex-dividend date. And that will be there, of course, if there is one. The liquidity, of course, we explained that in the beginning. 3 stars, meaning very liquid, very easy to trade in terms of options. Expected price movement, that's the volatility cone again, okay? But it's expressed in a different way. So if you're maybe just trading stock and I'm worried about, I want to hold Apple till June, I can click on that. We can see that maybe, it may go up 11%. Again, to harness that expected move probability, be aware of what's realistic in terms of your direction in the stock. And we use that, by the way, with our directional views and technical views. It has to be realistic. Extremely important. Okay. And finally, at the bottom, I'll just touch base on one of my favorite features. It's a peer comparison. So we know a lot of option traders are biased, and maybe they say they don't care so much about the symbol. They want to have the most premium available to sell a strategy or something with low IVR to buy a debit spread. We can compare now with Apple versus its sector. We can see other names in here. So Apple has an IVR of 67, implied volatility 29. It's gone up over the last 7 days. That's important. And we have one of my favorite filters. Again, you can filter by just clicking on the arrows. You can rank them. So now I have the highest IVR in the sector or the lowest if I want to do a debit trade. And then we have the IV versus HV, the implied versus historical. The higher the ratio, usually the interesting opportunity here, right? So right now I can see a high spread on HPE, Hewlett Packard, right? If I click on that, it's going to change my entire dashboard, right? We have a really high IVR, right? We have some history. It's pretty wide in this spread, which usually gives us an advantage, right? That in this case is telling us that implied volatility is much higher than historical norms. This could be an advantage if you want to sell options or sell a covered call if you own these shares. Okay. So again, here I'll show you an extreme example before I go because I'm running a bit out of time. I want to leave 10 minutes for questions. But if I go for something like a PLTR, a Palantir has been very popular recently, right? In the news, it's had some huge swings. We can see a super wide volatility spread. And when things happen like this, when we see an inversion, right, where implied volatility, right, is still even below historical norms, that's quite interesting despite the volatility the stock has. So this is a good example of a high IVR, which will be attractive to premium sellers of options or people selling covered calls, yet it's still below its historical norm, right? So there could be an advantage to even debit buyers or people want to buy calls. Now, from here, right, if I'm interested in this, right, now we're comparing it again. If I'm interested in options, I can quickly click on Strategy Lab. It's going to remember what I had last time, right? And it's going to give me the chart, the volatility cone, right? If I have a technical opinion, it will show up on the stock. Again, if it's beyond 7 days since we updated the chart, we may not have a chart for technical views. Not always. We want to keep things relevant and recent. And probably because of volatility, we have to re-update this one. But I can go ahead and say, maybe I want to do a bottom-up play. I can click go up, slightly upward, quickly limit my risk. Boom, I've got a bull call spread available right now, right? Again, even with a super high volatility stock like Palantir, it's falling within the expected move. It will always happen. This is the beauty of this tool. It's going to put you in the right direction to be successful. I can understand risking $600 to make $897 and a nice $15 wide spread, right? It's going to be a lot cheaper than just buying calls outright if you want to be successful. Okay, so there's a lot here. I'll be back with some more presentations on this because there's a lot to talk about. I encourage you all to play around with the tool. It's super fun, even if you're just a stock trader as well. And we want to encourage you to try out strategies or at least be aware of the risks, right? Maybe they're not so risky versus buying 100 shares of a stock like Palantir, right? Maybe, if you're a big covered call fan like I am, go ahead and play around with the creating income cash flow on US stocks. You can see some fat premium in here based on the dashboard. So again, the dashboard is to give you the data to help you drive your own strategy, right? For some people, this is enough to make sure I have the confidence to execute a specific type of strategy, right? Maybe you want to do a straddle or some iron condor, some more advanced spread, right? The strategy lab is to point you in the right direction if you've never traded options before and you want to start doing so and replicate being long or short stock. Play with the strategy lab, and even those who are very experienced, we use this every day as professionals to make sure we're in the right direction in terms of our spreads, just to help guide us. And we can understand these risk rewards are quite appealing, right? It's always going to be attainable, not too expensive, right? And that's what we want. We want people to have fun trading options. So with that, I'll leave it there. I think I went a little bit over. I'm, on the tool. I'm pretty passionate, obviously, about this product. I'll have some questions available right now. We have till the end of the hour, and fire away. I'll send it to the Qtrade team, and I'm also monitoring some questions as we go. But thank you all for coming today at lunchtime, right? Or depending where you are I'm in Ottawa, of course. But I'm always impressed to see people join and want to educate themselves on tools. It's going to really help you, empower you going forward. Thank you.
So now we're going to open the floor to questions. Please use the Q&A function to ask any questions. We'll be prioritizing questions about options trading first.
Yes.
We have a
So I
question.
can see them as well. So I'll answer some as they come across, and if I miss something, just let me know. For the risk on a max risk on a covered call, the real basic risk here is the stock goes to zero, right? Because you're only sold a premium for $4.15. You got that credit. You lowered your average cost of the shares, but what if the stock continues to decline? There is theoretically a max risk of zero. That's why. Highly unlikely, but it is possible, right? And I see some questions in here on, do you have a recommendation on which strategy to start with doing your first options trade? Great question. So normally the first stage is these covered calls, right? Because you already own the shares. And if you have a profit in your shares, try a covered call first, right? If you have a gain, right, and you don't mind giving up the shares, try it out and see, and the stock remains flat for some time, you can write premium and enhance, say, your dividend income. This is great for dividend stocks, and you want to sell premium, right? Then go ahead and learn that to sell that call. At the worst case scenario, you sell at a gain, right? And you created some income at the same time. The next stage, I would say, is what I generally do is looking for those debit spreads, okay? The bull call spreads. If I want to have the same exposure and I want to buy 100 shares of Palantir, it's very expensive to own 100 shares, right, at $84, $85, when I can only risk 600 for the same effect, right? Look at this one. This is a great example in Palantir as we're talking. Make no mistake, when you're buying a stock, you have a 50-50 shot, right? It could go up, it could go down. That's the true odds, 50-50. No one really knows where the stock's going to go. Although some people do pretend that they do know, right? We're not here to debate that. We know is that there's a 50-50 shot. Options are really no different here, right? So if you want to replicate that, but not spend, $8,500, right? You can do the same thing. This is almost 50% probability profit right now, buying the 85, selling the 100 call, right? This is what we want to drive across. You're risking 600 to make 900, right? This is the type of strategy I look for every day, right? And to lower my buying power so I can have more stocks in my portfolio. Yes. Next questions here. Yeah. Make sure I miss them all. Okay. Any timelines when Canadian markets become available? I'm testing that right now, right? So hoping sometime I'll wish before summer, but I can't really make a promise on that. We want to test it out and making sure it's giving us realistic strategies like you're seeing above. Okay. To what extent is AI used in the tool, right? So that's our behind our engine that calculates all these strategies all the time. So I can't get into too much specifics. There is some secret sauce in here, of course, and we're pretty proud of to make this work, right? But Trading Central is known with their AI tools. What's coming next is a whole chatbot feature, right? Coming down the line where we talk about summarizing the entire dashboard, right? And giving you an opinion based on the volatility. That's coming very soon. If it's an in-house version, though, we'll share that when it comes. But yes, I can't elaborate too much on that, but all that to say is yes, it helps us filter strategies. Lots of good questions coming in. So I know we have a short time to do this. I wish I had more time. I knew this would happen. So if you have more questions, please fire away. We'll get to them. Find me on tradingcentral.com as well. You can reach out to me. I don't mind doing that. But AJ, any questions that I missed on specific on the tool? Let me know. I think we
Yeah, we're
got them
getting
all.
a lot of questions right now, so
Yeah.
I think we'll send it over to you after. But thank you so much. Thank you to our presenter today, and thank you to all of you for taking the time to attend this event. We hope that you found it informative. We would love your feedback after the webinar. You will see an event survey link appear on your screen. Please take a minute to fill it out while it's fresh, or you can also fill out the survey when we send it out the post-event email, which will include a link to the recording. From all of us at Qtrade, thank you so much for attending our webinar, and we hope you enjoy the rest of your day. Thank you, everyone.
Thank you all. Been a pleasure. Happy trading.